Hello and welcome to this video. In this video, we are going to do a A-level question from paper 4, Specimen paper 2023, question 1. The question states that W Limited uses a budgetary control system to prepare the budget for the month of May. The director of W Limited estimated a production of 1,200 units and fixed overheads of $30,000. The following budgeted data is available for the production of 1 unit. Direct material 2 kilos at the rate of 12 per kilo. Direct labor 4 hours at the rate of $15 per hour. The fixed overheads to be charged to products on the basis of direct labor hours. The actual number of units produced and sold in May was 1,120 units. The actual and the budgeted selling price was $135. In the A bit of the question, we are asked to state 3 advantages of using a budgetary control system. There are various advantages of using a budgetary control system, like the budgeting helps in coordination between the departments for the usage of resources. If we see here, the direct materials will be purchased by the logistic department and it will be used by the production department, and likewise for direct labors the hiring will be done by the HR department as well as the pay will be fixed by the HR department, whereas the efficiency of the labor hours put in is checked by the production department. Hence, different departments need to coordinate and cooperate together so that the business can be successful, and this can be achieved when we have a proper budgetary system. Furthermore, it helps in setting the targets for the department, and which in turn can lead to motivation among the employees as well as the managers, because when there is a set goal to be achieved, this gives a sense of direction and a purpose to the managers as well as the employees so that they can plan, organize and achieve the given target. Moreover, it also acts as a benchmark to control whether the targets are achieved or not, and if the targets are not achieved, what was the cause of the variance, whether the variance was favorable, whether the variance was adverse, and how the targets were achieved and how far the goals were fulfilled can also be controlled by means of a budgetary control system. In the B bit of the question, we are asked to prepare the statement to show the total flexible budgeted profit. We make the flexible budget based on the actual production. So we are going to do the calculations in our working notes, and then we will proceed and make the statement to show the total flexible budgeted profit. So we'll start with the sales revenue. The number of units which was actually produced was 1,120 units, and the selling price based on our budgeted rate was $135. So when we multiply, we get the sales revenue as $151,200. Then direct material. You see, for 1 unit we are using 2 kilos of direct material based on our budgeted estimation, and here we are actually producing 1,120 units, and for this if we multiply it with 2 kilos we will get 2,240 kilos of direct material which was used, and for 1 kilo we are paying $12, and for this it will be 2,240 times 12, which will be 26,880 will be the total direct material cost. Then we have direct labor. For 1 unit we require 4 hours of direct labor. So for this it will be 4 times 1,120 units, which will be 4,480 labor hours which will be required for the total production. And it was also estimated or budgeted that we will pay $15 for 1 hour. So it will be 4,480 times $15, which will be $67,200. Then fixed overhead will be calculated, and this will be calculated by using the absorption costing method, and there we calculate the OAR, that is overhead absorption rate, and this can be calculated on the basis of machine hours or direct labor hours. Here it is mentioned that it should be calculated on the basis of direct labor hours. So we are going to calculate that using the formula, that is OAR is equals to total budgeted overhead expenditure divided by the total budgeted number of direct labor hours. Here it was mentioned that the budgeted overhead expenditure will be $30,000, and For 1 unit we are using 4 labor hours, so the budgeted units are 1200 units, and when we multiply this with 4 we get 4800. So 30,000 divided by 4800, we will get OAR as $6.25 per labor hour. This is for 1 labor hour. So our total labor hours which was required here is 1120 times 4, which was 4480 hours, and we will multiply this with $6.25. We will get the fixed overheads as $28,000. Now we will find the profit. How we will get the profit? We will take the sales revenue. From there we subtract all the direct and the indirect expenses. We will get the profit. Sales revenue which we calculated was $151,200. Then the direct material which we calculated was $26,880. Direct labor which was calculated was $67,200, and the fixed overhead which was calculated was $28,000. So when we subtract all the expenses from the sales revenue, we get the flexible budgeted profit as $29,120. Furthermore, additional information is provided. Actual cost incurred for were as follows. Direct material was $27,300, and for this they have used 2,184 kilos of material. Direct labor which was $67,466, and for this the labor hours was 4,424 labor hours, and fixed overheads was $29,500, and the total cost was $124,266. In the C bit of the question, we are asked to calculate the different variances. In the first bit of the question, we are asked to calculate the direct labor rate variance. You see, variance is the difference between what was budgeted and what was actually occurred. If the budgeted cost was more and actual cost was less, then it is called as favorable variance, as it has a positive effect on the profitability of the business. And it's vice versa. You see, if the budgeted cost was less and the actual cost was more, that means there is increase in cost, and this will have a negative effect on profit. Hence, it is an adverse variance. Here we are asked to find the direct labor rate variance. So for labor rate variance, we are going to take the different labor rates which is given. That is, we have standard direct labor rate, and from here we will subtract the actual direct labor rate, and then we multiply this with the actual direct labor hours, because these are the hours for which we pay this labor rate. So here we don't have the actual direct labor rate given in the additional information. For this we will calculate. What we will do is, this is the total labor cost which was paid, and this was paid for this many hours, that is $67,466 was paid for 4,424 hours. So for 1 hour, what was the labor rate? We are going to do it by dividing it, that is 67,466 divided by 4,424 hours. We will get the labor rate as $15.25 per hour. So this is for 1 hour. If you remember, the actual standard labor rate was $15 per hour. Now we are getting $15.25 per hour. That is, the actual rate which we paid was more, and it was 25 cents more. That is, $0.25 was more paid per hour. And when we multiply it with the total number of hours, it is 4,424 hours. So we will get a negative or an adverse direct rate variance of $1,106, as this is an increase in cost and have negative effect on the profit. Hence it is negative, and hence we call it as adverse variance. Next, in the next bit, we are going to calculate the direct labor efficiency variance. Efficiency is how many number of hours was required to do the production, and if you were able to do the production in lesser number of hours, that means you have been more productive or more efficient. So in the same way, here we are going to see the labor efficiency based on the number of hours which was put in by the laborers. The standard direct labor hours we are going to take, and then we will check it with the actual direct labor hours and multiply it with the standard direct labor rate per hour to find with what was the variance. If we see here, the standard direct labor hours which was estimated was 4,480 hours, but in actual production we just utilized 4,424 hours was required. So here, as standard number of hours were more, but in actual production we were able to accomplish this in a lesser number of hours. So when we multiply this with $15, we will get a favorable variance because we were able to reduce the cost by $840, and this will have a favorable effect on our profit. Next we have fixed overhead expenditure variance. Fixed overhead expenditure variance is equals to standard fixed overheads minus the actual overheads. The standard fixed overhead was given in the beginning of the question as $30,000, and the actual fixed overhead which was given before bit C in the additional information as $29,500, and as the actual paid was less, hence it is a favorable variance of $500. Then we have fixed overhead volume variance. Fixed overhead volume variance is equals to standard hours for actual outputs which was calculated in the bit B of the question, and then we have the budgeted hours. Budgeted hours, it is mentioned that we are going to produce 1,200 units and each unit require 4 hours, so it will be 1,200 times 4 which will be 4,800 hours. And then the budgeted OAR which was again calculated before the bit B of the question, so it was $6.25. So when we apply this to the formula, it is 4,480 minus 4,800 times $6.25. So we get a negative $2,000, and it is an adverse variance. Furthermore, additional information is provided which states that the director have identified that there was an adverse total direct material variance of $420. In the debit of the question, we are asked to prepare a statement to reconcile the flexible budgeted profit from bit B with the actual profit. The flexible budgeted profit which we calculated in the bit B of the question was $29,120, and here it is mentioned that there is an adverse total direct material variance. So this is a negative value which have to be subtracted, which is $420, which is our total direct material variance, and as it is adverse, it is subtracted. Then we have calculated the total labor rate variance which was again adverse of $1,106. We have calculated the total labor efficiency variance which is $840, and this is favorable. And when we take this as negative and this is positive, we will get the total labor variance. That is, these are two subvariances. So when we add them together, we get a total direct labor variance which is an adverse variance of $266. Then we have also calculated the overhead expenditure variance which was $500 favorable, and overhead volume variance which was adverse 2,000. So this is negative 2,000, positive 500. We will get a negative $1,500 which will be an adverse variance. And after subtracting these three, that is from 29,120 we subtract 420, we subtract 266, and we subtract $1,500, we will get the value as $26,934. And to reconcile, we will take the sales revenue which we have calculated in the B bit of the question. From there we will subtract the actual cost which was given in the additional information before bit C. In this also we will get the same value as $26,934. Hence we have made the statement to reconcile the flexible budgeted profit with the actual profit. Furthermore, additional information is provided. W Limited received orders for goods to be supplied in June from 3 customers only. Customers A, B and C. Units ordered A 300, B 700, C 400. Unit selling price is $135 and $130 and $132. The budgeted data for the May for the production of 1 unit remains valid. However, W Limited have to pay an overtime premium of 75% to the workers for the production in excess of 1200 units in a month. W Limited is considering two options only. Option 1, accepting the order of A, B and C. Option 2, accept the order of A and B only. In the EBIT of the question, we are asked to advise the director which option should be chosen, and we have to justify our answer by showing the calculations, and as well as we have to also give reference to non-financial factors. Before proceeding, let's do all our calculations in our working notes. First option, here we have A, B and C, all three are selected, and the selling price which is given here for A, the units are 300 and the selling price is $135. So to calculate the sales revenue, we are going to do this. We are going to take 300 times $135 for A. Then for B it will be 700 times $130, and for C it will be 400 times $132, because in option 1 we have all three A, B, C are selected. So we will get the sales revenue as $184,300. In option 2 only A and B is selected, so we are going to just take the sales revenue for A and B, that is 300 times 135 plus 700 times $130. So we'll get the sales revenue as $131,500. Now next we have the direct material. It was mentioned that the direct material was we require 2 kilos of material, and for 1 kg we have to pay $12. So this was already mentioned previously in the first part of the information. So we are going to take all the three options, that is A, B and C. 300 plus 700 plus 400 times 2 times 12, that is this is 24. So when we multiply it, we will get the direct material for option 1 as $33,600, and then the direct material for option 2, when we are considering only A and B, will be 300 plus 700, and this will be multiplied with again $24 because 2 kilos and per kilo it is $12, so it will be $24. So we will get the value as $24,000. Then again we have after that labors, because we have asked us not to consider the overhead, so we just calculate the fixed overheads are not calculated. We are just going to calculate the direct material and the direct labor. So when we go for direct labor, we have again for option 1 it is 300, 700 and 400 units, and it was mentioned that for each unit we require 4 labor hours, and the price which was mentioned was $15. So 4 times 15 it will be $84,000, and for option 2 it is 300 plus 700, because we are not going to take the C customer. So this times 4 into 15 it will be $60,000. Furthermore, it is mentioned that if there is a production which exceeds 1200 units, then a overtime premium of 75% to the workers have to be paid. So if we see option 1, we are producing 300 plus 700 plus 400, that is 1400 units, that is 1400 units to fulfill the demand of all the three customers, and here we are exceeding 1200 units. So we are exceeding it by, this is 1400 units, and here it is 1200 units. So the exceed is with 200 units, and for this 200 units we have to pay a overtime premium of 75%. So 200 times 4 times 15, we will get this as this will be $60, and 60 times 200 will be $12,000, and from $12,000 we just need to take 75%, so it will be $9,000, and this will be the overtime premium for option 1. In option 2 we are producing 300 plus 700, so we are not exceeding this limit of 1200 units. So for option 2 we do not require any overtime premium. Now let's proceed with the solution. As we have done all the calculation, we have option 1 and option 2, and as we are not considering the fixed overhead, so we are not going to find the total profit, we are going to find the contribution. So we have sales revenue which we have calculated for option 1, it was $184,300, and for option 2 it was $131,500. Direct materials which we calculated was $33,600, and as these are the expenses, we are going to subtract the expenses from the sales revenue to get the contribution. For contribution, we take the sales revenue, from there we subtract all the variable expenses, and the variable expenses which we have here are direct material, direct labor and overtime expenses, and we will get the contribution. So for direct material, for option 1 it is 33,600, for option 2 it is $24,000 which are subtracted. For direct labor it is $84,000 for option 1, for option 2 it is $60,000, and we also know that there is an overtime premium which have to be paid for option 1, which was calculated as $9,000. So based on this, the contribution for option 1 is $57,700, and for option 2 is $47,500. We have to consider the non-financial factors. For option 1, we are using the full capacity. Not only just the full capacity, we are producing 200 units more than the full capacity, because 1200 was without the overtime, but with the overtime we were producing 1400 units for option 1, and we were fulfilling the demands of all the three customers, that is A, B and C. Hence all the three customers are satisfied, and even the workers will be happy because they are going to get an overtime premium of 9,000 here. So you see, money is a very good motivator, and as it is a very beneficial motivator for workers, naturally this will make them more happy and they will be more efficient, and thus there may be more productivity in future as well. So these are the non-financial factors. However, for option 2, what we have here is we are not using the full capacity. We are producing only 1000 units. So we do have spare capacity of 200 units, and this can be used if there is some emergency or a urgent customer who wants the order to be fulfilled and is ready to pay a very huge amount. In that situation, this will be better. But and one more thing is that here the workers are not overworked, as there is no overtime, so they may be more efficient. But from my point of view, I will consider option 1, because this is a more suitable option where the workers will be more happy with the more pay. We are fulfilling all the needs of the customers because all three customers will be satisfied. We may not lose customer C, because we are also fulfilling the demand of customer C as well in option 1, and we are using the full capacity. So from my point of view, I select option 1. It's up to you to select option 1 or option 2, and you have to support your answer. With this, we have completed this question. Thanks for watching my videos. Have a peaceful and blessed life.